Advisory services offered through VestGen Advisors, LLC, an SEC-registered investment advisor. Securities offered through Private Client Services, LLC, member FINRA and SIPC. Private Client Services and VestGen Advisors, LLC are unaffiliated entities. Any information discussed does not constitute investment advice. VestGen Advisors and Private Client Services do not offer tax or legal advice. People of Chicago, welcome to In the Know Radio with Craig Bolanos, co-founder and wealth advisor at VestGen Wealth Partners. You want help from someone you can trust, someone who knows what it takes to get retired and stay retired. Today, Craig's going to teach you what you need to know. So get ready to learn something that could change your life. Get connected to the show by calling 833-964-PLAN or go to getretiredstayretired.com. And now, here's Craig Bolanos.
Well, hey, good morning and happy Sunday, delivering you the sincere and actionable ideas that you need not to survive, but to thrive in retirement. Hey, everybody, you know it. It's October. Is it going to be big, bad, and scary? Or are we going to have a follow through of the September rally? Only time's going to tell. But you know what? We got 90 days left in the year. That's 90 days to make excellent decisions. That's 90 days to finish strong. And here's the truth. We got to do a Q3 recap, and we got to look back at a market that had 3 different markets inside of 9 months. In addition to that, I think we absolutely need to talk about this concept of real return investing. Yes, it's something you need to pay attention about if you want to secure your money. And in addition to that, we're going to talk about the financial planning and modeling that you're likely not getting that you deserve to get so you too can elevate and level up your retirement plan. And joining me in the studio is David Bolanos. David, good morning. A very happy Sunday to you. And David, we're going to banter on this for just a minute, but we got to tell everybody, in case they didn't know, the market rallied to all-time highs in the third quarter of 2025. And that was a combination of a whole bunch of things. I mean, we had the passage of OBA, the One Big Beautiful Bill Act, and that had numerous parts of stimulus in it. Most importantly, making those 2017 tax cuts permanent, giving all the business owners, the job creators out there, accelerated depreciation, and of course, a dose of optimism for everybody that's making its way into people's pocketbook just in time, like non-taxable overtime, non-taxable tip. And for anybody who's crossed the bridge and is using Medicare, who doesn't like Medicare, you've got an opportunity to get those bonus deductions. But David, I've said it once, I'm going to say it again. You got to pay homage to the fact that we've had 3 markets in literally 9 months. I mean, the year started with Trumponomics, and Trumponomics were good. It was the ability to get a rate cut. It was the ability to get deregulation, the ability to have tax cuts. And in addition to those items, it was going to be nothing short of a renewal of that Tax Cut and Jobs Act and a pro-business environment. And you know what? Oh my gosh, it turned on a dime, didn't it? Oh, it sure did. Listeners, you remember how nasty March and April were? You certainly do. We had that speech at the Rose Garden. Some people called it Liberation Day, but I saw a market that cascaded down not 6, not 12, but 16% in a handful of days. I saw technology stocks. I saw AI enthusiasm go away, people questioning valuations. But wait, then people said, hold on a second. The TACO acronym is here, and we're not actually going to follow through on full reciprocals. It was a technique. And then with that, the market responded. And we went from Trumponomics, from recession paranoia, into where we find ourselves today, which is nothing more than AI enthusiasm. Yes, AI enthusiasm. As we're doing our quick market recap, because it is the end of the third quarter, everybody deserves to know that the AI-related corporate profits have been nothing short of fantastic. The U.S. economy has remained stable with economic growth, and that's all come together to help propel things higher. And if you think about market cap, we're going to nerd out. David's going to talk about what market cap is in a minute. A sector of the market that's been completely unloved, that spent a good part of the year in negative territory, small caps, all of a sudden came to life on the hopes of these rate cuts. So what's the bottom line? when we do our third quarter wrap up, well, here it is on a sector level. 10 of the 11 sectors in the S&P 500, they all finished with a positive return. And no one should be surprised that it was tech and tech-aligned sectors, think about consumer discretionary and communications, that comfortably outperformed everything. And thank heavens for the like of all those AI-linked stocks, Microsoft, Alphabet, Amazon, NVIDIA, Oracle, and Broadcom, and others, because they kept the investor enthusiasm high. David, what is the wisdom and the practicality that people need to know as you bridge this topic of Wall Street to Main Street for all the investors that you serve across the country? Put a bow on that third quarter recap and give us a tease as to what you see coming into Q4 of 2025.
Follow the data is the way I would summarize it. And you had mentioned, we got some stimulus from the big, beautiful bill. I would add on top of that, we had really good earnings growth. So corporate profits came in above expectations. And then we did get some trade deals done, in the middle of this year. But if we're following the data, we also have to talk about the negative side too. So what I would say is like, if there's one thing that we learned is this summer, we didn't get the best jobs numbers and we got some revisions. So for all of the positives that we went through, and these are really big positive, hence stock prices moving to all-time highs, I would say if there's something that I think about, I really feel like the labor market and consumer spending has been the glue that's kept this economy together. Maybe we're just starting to see some cracks. And that's just a good reminder that there's always risk in markets. I mean, that's my take on it, Craig. I feel like it's been big spending on AI infrastructure, and it's been consumer spending despite negative sentiment. How do you feel about that? Because that's definitely something that's popped up on people's radar.
I'm going to say it again. At VestGen Wealth Partners, we follow a data-driven model because sentiment is useless. Data is systematic and repeatable and allows you to be disciplined, because think of how many people got head faked and uninvested or underinvested in this market this spring. Boy, that was a mistake. And David, when you say, how do I feel? Listen, I'm happy. We're no longer living in Goldilocks. It's not too hot. It's not too cold. It's not just about right. If anything, we see the fragility, but the trend is your friend. And remember, David, there is plenty of history on all sides to say if the Fed is cutting rates in a non-recessionary environment, if the Fed is cutting rates in a non-recessionary environment supported by a bull market, then what do you want to make sure you don't do? Well, you absolutely don't fight the Fed, and you just lean in and trust the tape. And yeah, David, I'm going to give us some color commentary here. Is the labor market deteriorating? Yeah, of course it is. We've been living in this no hire, slow fire period for a long time. And David, am I getting a little bit anxious once in a while because the inflation remains? Well, I still think it remains stubbornly high. I mean, inflation just under 3%. Gee, that's not near the Fed's targets. And then if I had to stay on the tariffs, well, I guess my comment is there's still substantial policy uncertainty. I mean, what if the Supreme Court says tariffs are actually illegal? So there's a whole lot of stuff we're going to find out about in the fourth quarter, that last one in particular, because we should find out about the Supreme Court ruling sometime in the month of November. But I think the bottom line, David, if I put a bow on it so we can talk about being forward looking, is everyone should just know that AI and tech enthusiasm has driven the valuation of the S&P 500 to a historically high level. And we should recognize, and I think you're hinting to this, David, that elevated valuation by itself isn't a negative influence on stocks, but high valuation does underscore the reality that a lot of profit growth, future profit growth, is priced into the largest tech stocks. And if there's any AI-related capital expenditures from major tech firms that begin to decline, or AI adoption disappoints investors in some way, shape, or form, it could be a surprise. No, wait, it could be a substantial surprise for markets. So you know what?
100%.
Yeah. So David, I think what we do at VestGen Wealth Partners is we understand those risks. We speak about those risks, and we're committed to helping people, helping this listening audience effectively navigate the investment environment, because, you've oftentimes said this, David, successful investing is a marathon. It's not so much a sprint. And that's what I'm thinking about on a Sunday morning. So, David, give us a taste of what the fourth quarter might bring. And maybe that'll be a good segue into real return investing.
Yeah. I mean, the backdrop is still fundamentally okay. We maybe have some cracks in the foundation, but the trend is your friend. And if the Fed's going to lower rates and we don't have recessionary data, you have to be in the stock market. And what we've learned in 2025, again, is we will always have short-term disruptions, but if you can see through to the end, usually it never ends that bad or that good. The truth is always in the middle. So I think investors need to stay involved. I think what investors should be thinking about is how do you rebalance towards the end of the year, keeping in mind that you probably have some unrealized gains in your portfolio. And perhaps after the break, Craig, we can talk about how to rebalance to set up for efficient RMDs, how to rebalance and make sure you capture that special senior bonus deduction in your retirement plan.
I love it. Let's do all that and more. So in the meantime, if you want to connect with us, go online, getretiredstayretired.com. That's getretiredstayretired.com. When you cruise out to that website, getretiredstayretired.com, download some of our important guides like One Big Beautiful Bill Act. That's tax opportunities for investors. Listen, we've got sincere and actionable ideas that you can't afford to miss coming back after the break. You're listening to Craig and David in the know. VestGen Wealth Partners, AM 560, The Answer.
You want more in the know radio? You want more in the know radio? You can't handle more in the know radio. Okay, yeah, you can. And it's on AM 560, The Answer. Welcome back. Here's more with Craig.
Hey, we're back. You know what? That was a great first segment. In case you missed it, because you're coming home from church, whatever it might be, I want you to go out to our website, getretiredstayretired.com. That's getretiredstayretired.com. David and I just broke down everything that happened in the third quarter. We talked about the tale of three markets, Trumponomics to recession paranoia to AI enthusiasm. But you've got 90 days. That's 90 days left to make excellent decisions, 90 days to support you and your family. And one of the themes that we've constantly been setting the table for, David mentioned it, is how to rebalance portfolios going to the end of the year. Again, stretch valuations in the S&P 500 by themselves are not a problem. It's once an outside influence affects that stretch valuations that the cracks begin to show. But I thought it would be nothing short of a treat to bring one of the wizards behind the curtains into the voice of radio. I've got Bob Hotstetter, our Chief Investment Officer, on the phone with us. And Bob, you and I talk a tremendous amount of time about the concept of real return investing. Succinctly and efficiently share with our audience why they should be turning their eyes towards this concept we've dubbed of real return investing into Q4 and early 26.
Well, thanks, Craig. I really appreciate you inviting me. I'm glad to be here. Real return is really an interesting kind of back to the future idea. It's a concept that's been around in finance for a long time, but people don't talk about it very much. And real return really simply means the return that you get to keep after the cost of inflation. And so, real return is, why you might feel like your stock portfolio is at all-time highs, but yet you're worried about achieving your life objectives or, just expenses that you might have day to day.
There you go. So, Bob, real return investing is the real return on your money after you account for the silent killer. And everybody knows the silent killer happens to be inflation. It's not hypertension, guys. You can take some lisinopril. You'll be fine. Trust me on that. Okay. But Bob, let's put this into practicality, because I think everyone's seeing the lens of inflation simply through the grocery store. They're seeing the lens of inflation from the fact that they're buying their holiday decorations. Makes me sick to my stomach. There should not be holiday decorations out yet, guys. It's only October. I want to see nothing but Halloween. But Bob, a lot of it is not just consumer prices. A lot of it is not just producer prices. A big part of what goes into consumer prices and producer prices happens to be this thing that nobody understands unless they booked a Viking River cruise in January and decided not to pay for it in October to go through the European theater. Talk a little bit about currency and how VestGen advisors are solving for inflation from a currency standpoint. What can we be doing in terms of storages of value?
Yeah, thanks, Craig. I think you mentioned it before, and you feel it when you book the Viking River cruise, but the dollar has been down about 10% year to date. And that hasn't happened in a long time. And that's why the Viking River cruise seems more expensive because it's priced in one currency, and US purchasers, vacationers have bought it in US dollars. So that's the challenge there. I think the main thing about real return is that it applies this idea of inflation, which is an expense idea, into the capital markets. Because in some ways, capital markets is what's driving that grocery store or the Viking River cruise experience. It's the flow of capital, and it's the decisions that are made at the macro level that are affecting portfolios. And what a lot of people are doing is they're looking at their portfolios and they're just saying, number go up, right? And that's kind of what's happening. But that's not necessarily the right way to think about it. You should be thinking about what's driving the number going up and what might cause it to change, pivot. Where might the number go up more and where might it go up less? How do you construct a portfolio that takes those risks into consideration?
David, you spend so much of your time helping clients across the country get retired and stay retired, helping those clients thrive, not just get by and survive. That's not acceptable to anybody. David, how do you view real return investing for your clients? Talk about how you're going to deploy additional legs of that and give us some further insight into what it means to you as a practitioner.
Everyone on my team's had conversations with families where they say, things just feel a little bit tighter. And to your point earlier, Craig, I think what they mean is maybe the dollars just aren't going as far when they go out to dinner. It's more expensive. Their utility bills are higher. So we need to find ways to address that. Now, the typical ways that we might find it are, we talk about growing income in portfolios, dividend growth, things of that nature. But I think what's changing is we spent the first segment talking about AI, and I think that's a great core component of everybody's portfolio. But what I think about is what are the other ways that we can play that AI opportunity set, perhaps not in some of the biggest stocks, but in some of the AI enablers, meaning the infrastructure investments, meaning the commodities and energy exposure it's going to require to power those things. And a lot of that comes through as tax efficient income. And we don't want to break that down on a Sunday morning on the radio.
No, David, pause. David, this is about sincere and actionable ideas. I'm going to turn into that. What do you mean by investing in the ecosystem of AI enablers? And then let's kick it over to Bob to talk a little bit about other forms of commodity or storages of value like precious metals. David, what are AI enablers and how is VestGen implementing that through client portfolios?
Yeah, everybody knows if you drive down the highway or whatever town you live in, right, you see these data centers being built. And what I often hear people in the construction business say is the companies that are funding these data centers never ask what the cost of the project is going to be. They typically ask, how quickly can you get it done? So there's this huge demand, and you can certainly play that in the publicly traded markets. But where we've implemented dollars over the last 18 months is to play into the privately held data centers, the infrastructure, the fiber optics, and the energy. And part of that is collecting tax efficient dividends through return of capital. So for investors that are using non-qualified money, joint accounts, trust money, what I care about is your after tax return. And with a lot of those investments, a lot of that dividend is coming through and it's not taxable to all investors. So it's not just what you earn on paper, it's what you keep net of taxes. And if we are worried about the cost of living, then one of the ways that we can hedge our bets is to make sure we keep more of what we earn and we're not giving any more than we need to the IRS.
833-964-PLAN. That's 833-964-PLAN. Go out to our website, getretiredstayretired.com. Connect with us, connect with David, and learn how you can work with and invest through AI enablers for tax-efficient income. Bob, we started talking about real return investing. David just talked about a strategy that he's using as a small satellite within core portfolios. Bob, how should we think about commodities? How should we think about precious metals in this concept of real return investing?
Well, I think the thing that a lot of folks maybe aren't aware of is that dollars are basically not money, they're credit. So when we think about currency, it's a credit, it's a promise to repay. Fixed income is also a credit, it's a promise to repay. In an environment where you have elevated inflationary pressures, the promise of a dollar tomorrow is worth less than it would otherwise be worth, because that dollar might be worth less in the future. And so that brings you to what are other sources of value? You use that term, Craig. I agree with it. I think in addition to gold, one of the reasons why digital assets have started to do better is because people begin to realize that that's an alternative to dollars and, frankly, to all the major money currencies, because this isn't just a US dollar challenge. It's all developed markets that are facing this challenge. And so taking a portion of a portfolio and allocating it to some kind of store of value that's going to be impervious to the amount of money that's being printed is a good strategy for the long term.
You know what, Bob, if you'll give us the extension of grace, I may hold you over into the next segment, because I think we deserve to speak the truth about the printing press that is going on in the countries who have fiat currency and are printing dollars that their bodies can't cash. And that's why a big part of staying retired is solving for all forms of inflation. Now, in case you're wondering, the US dollar remains the world's reserve currency. In case you're wondering, no, foreign investors are not dumping US treasuries. But the reality is people are starting to not be as dollar denominated as they once were. And if you're armed with that information, what might you want to do about it? And what might your considerations be? Now, a lot of people talk about solving for income. They talk about solving for growth, but too many advisors aren't solving for the concept of real return. That's what we're focusing on a Sunday morning. So in case you're just joining, if you want some help because you feel that you're doing fine, but you know that you should be doing better, is that an investment thing? Is it a goals-based planning thing? A cash flow model thing? A tax thing? An estate thing? A retiree healthcare thing? It might be an everything thing. And if that resonates with you, it's time that you work with a team, no longer a solo advisor practice. And I invite you to learn what a family office for Main Street looks like. We do that, and we do that very well. If you want to connect, it's easy, and I think you should. 833-964-PLAN. That's 833-964-PLAN. Go out to our website, getretiredstayretired.com, getretiredstayretired.com. David, Bob, if you're good, I'm holding you both over to the next segment. We're going to pay the bills, do a commercial, and then we're going to talk about the printing press that's running wild, not just in DC, but around the globe.
Would you like a dose of knowledge? Good, because Craig is back and about to fill your retirement prescription. Back to In the Know Radio on AM 560. The Answer.
833-964-PLAN, 833-964-PLAN. GetRetiredStayRetired.com. That's GetRetiredStayRetired.com. You know, if you haven't noticed, whether it was the CARES Act, whether it was the American Rescue Plan, whether it's whatever name we want to put on it, we have seen such a surge in the amount of the U.S. debt, which means we have put so much money in motion by running printing presses. I'm not surprised the government's currently shut down. I know you're not surprised there either. It's always about the money. But when you wildly put so much money in circulation, not just in the United States, but throughout every developed country that is guilty of the same, it begs the question, what are you doing in your portfolio to make sure you're pursuing real returns. So I bring back into the conversation Bob Hotstetter, our Chief Investment Officer, David Bolanos, one of our top wealth advisors. I want the two of you to go back, but Bob, get us started on the problem you see with all this money that's been printed in developed nations through various forms of stimulus, and how digital currency might help solve for some of it in addition to precious metals.
Yeah, thanks, Craig. I mean, I think that the thing that we need to start with is that money, paper money, is what's known as fiat. So it resides on the strength of the promise of the sovereign country to repay. And if it's not tied to gold or not tied to some peg to some other currency, it's entirely within that country's purview to decide how much of the money it should make available in the system, and how it should intend to price its debt, how it should manage its own affairs. We operate in one of those countries in the United States, and all the developed nations do the same. Now, since we moved off the gold standard after the Bretton Woods Accord in the early 70s, the dynamic, which has been accelerated through COVID and recent events, has been slowly evolving, and everything has been moving well in that direction. We've had great prosperity, economic expansion, and we're not near a precipice or any kind of dire situation in the United States or in most of the developed countries. Some are worse than others, but we're in a state where we need to start thinking about what's driving the inflation at the grocery store, and how does that factor into our portfolios. And things that are not printed, like gold, Bitcoin is something that cannot be expanded. There's 21 million Bitcoin that exist. That's done by a computer program. So it doesn't have the same dynamics that fiat currency has. So many of these assets start to become interesting in the context of that broader secular development. Again, this is not a sky falling kind of moment. It's a moment to start leaning into some things and maybe leaning away from some other things in terms of portfolio construction.
And David, you've always talked about an ounce of prevention is worth a pound of cure. And I think this falls into that realm. So David, how are you taking Bob's thought leadership and turning it into client experience? Because you know that clients are talking about this with us. How are you responding with sincere actions?
I mean, with investing, we never deal in absolutes. And you mentioned, Craig, the dollar still remains the world's reserve currency. So we're not saying it's going away, but we are suggesting to people that maybe times are changing a little bit, and that might require you to change your portfolio accordingly. And I think what we're also suggesting to folks is, if you've made it to retirement and you've made it through the first several years, your only job is to hold on to it. But the tools that maybe you used in the past, those might not be the right tools to use in the future. And what we talk about is leveling up your plan, right? Getting educated on what the other opportunity sets look like. And if you're a family that's acquired a certain amount of worth, you've done it the old fashioned way, good old fashioned sweat equity, then maybe it's time to rebalance your portfolio going into 2026. Complacency is probably the enemy for the end of the year, and start to look to allocate to some other asset classes. But if your conversation with your advisor today is, hey, the dollar's down, maybe we need to buy some more international stocks, maybe that's step one. I think what we're talking about, the three of us on the radio this morning, is how do you get to step 2, 3, and 4? And that's why we're talking about these other asset classes and just thinking about this a little bit deeper as we try to protect and grow this money long term.
833-964-PLAN. That's 833-964-PLAN. Go out to that website, getretiredstayretired.com, getretiredstayretired.com. We're having the conversation that deserves to be spoken about. It's that conversation of what's driving inflation. It's that conversation that you should no longer be focused on the nominal return on your money. You need to be focused on the real return of your money. And as David said, it's about being 2 steps ahead, constantly thinking 2 steps ahead. So Bob, how does an allocation, I didn't say an account, I said, how does an allocation to things like precious metals help the rest of a core portfolio?
Well, for one, the corollary effects, the covariance, the way that one asset moves relative to another asset is what's known as is really the engine of diversification. And one of the things that's great about precious metals and commodities and digital assets is they display reasonably low correlation relative to their own independent risk return profile. What does that mean? It just means that you can add a little more of the ingredient and not contribute that much to overall portfolio volatility. So that's what we've done in terms of the real return approach that we use at VestGen is we've really thought about that portfolio. We've thought about where these stores of value could create opportunities for investors, and then thoughtfully put together those portfolios in a way that regardless of where you fit on the risk spectrum, you can participate in an appropriate amount of those kinds of diversifiers. And it's really diversifiers with a specific purpose in mind. And it's the preservation of capital and purchase power against the, risk, the elevated risk of inflation.
So I've enjoyed the run in 23. I've enjoyed the run in 24, and I don't see anybody complaining about the run in publicly traded markets in 25. As David said, it's about making sure you're rebalancing your portfolio in line with your risk budget. David, mention quickly what a risk budget is from the VestGen Wealth Partner side and how we've incorporated some of these in our global strategies already year to date.
Yeah. Well, I think when I think of risk budgeting, the first thing I think of is what's the minimum rate of return you need to earn on a certain subset of your money to get you retired and keep you retired. And then, as you said, Craig, we're not advocating to deal in absolutes. So you have to be involved in these markets. We're not telling you not to be involved. But I do think that when you have stretched valuations, you use that as an opportunity to take some off the table. And if you have any concerns that inflation is not going to come down as quickly as the government tells us, then why wouldn't you at least get educated on what that opportunity set looks like? But this is why every decision you make with your portfolio has to be vetted with your tangible retirement plan. You need a real retirement plan. Your retirement plan is not to buy an annuity. It is not an advisor telling you, I think you'll be fine, you have enough money, because you don't want to be okay. You want to be good and then go from good to great. And the only way you do that and being a good steward of the capital is to keep learning, growing, and dot the I's and cross the T's. And I think that's why we practice holistic financial planning here.
833-964-PLAN. That's 833-964-PLAN. Go to the website, getretiredstayretired.com. That's getretiredstayretired.com. We're here to do one thing. We are here to educate you because education leads to empowerment. And when we're ready, we will help you execute with bespoke solutions that are, of course, tailored to you. That's tailored to your retirement plan, your cash flow plan, your estate plan, the entire kit and caboodle. 833-964-PLAN. Get retired, stay retired.com. Bob, I had fun throwing you into the studio from afar. Thanks for dialing in this morning on a Sunday. My best to your family. David, as always, I appreciate it. David, I'm going to hold you over because we got to talk about some things like capital gains coming into the end of the year and being mindful about how to qualify for that $6,000 bonus deduction per person, courtesy of the One Big Beautiful Bill Act that was passed on the 4th of July. Bangs, barbecue, booze, and tax cuts. They're all here. You're listening to VestGen in the Know, AM 560.
It's more In the Know Radio with Craig Bolanos on AM 560 The Answer, where his goal is to pummel you with financial know-how until you say uncle.
Hey, I've got news, everybody. It's the fourth quarter of the year, and you need to proceed with caution. Caution, Will Robinson. What am I referring to? It's end of the year, fourth quarter, and repeat after me. Thou shalt never, ever, 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 ever buy a stock mutual fund in your non-retirement account in the fourth quarter of the year. David, what's our rule? Say it after me. Thou shalt never, ever, 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 ever buy a stock mutual fund in the fourth quarter of the year in your joint account, individual account, trust account. And the reason for that, it's not the Phantom Menace. It's not the Phantom of the Opera. It's what, Dave?
It's the phantom income tax. That was a lot of never, never, nevers. But what we know is mutual funds might be fine for 401ks and IRAs, but stock mutual funds tend to pay year-end distributions in the middle of December. And if you buy the mutual fund on December 1st and it pays out on December 2nd, I got bad news. No matter what, you are going to end up with a tax bill, even though you just bought that fund. And in years where the stock market has tremendous volatility, oftentimes those year-end distributions are very, very large. And what would we see this year? A great January, February, only to be followed by a tough March and April, only to be followed up by a V-shaped recovery to new all-time highs. I consider that a lot of volatility. So investors should be aware that these stock mutual funds might be passing through a nasty year-end distribution. You still have plenty of time to rebalance your portfolio to perhaps avoid those distributions and find a more tax-efficient way to invest moving forward.
So if you want to sidestep those phantom income tax bills, you know what to do. 833-964-PLAN. That's 833-964-PLAN. Go out to our website, getretiredstayretired.com. That's getretiredstayretired.com. David, talk a little bit about how VestGen rebalances portfolios not once a year, but throughout the year, because it's all about dynamic rebalancing. David, explain the benefits of that for all of the listeners.
Well, the language I always use is markets don't care if it's March 31st or June 30th, et cetera. Markets are going to do whatever they need to do to confuse as many people at any given time possible. So when we rebalance, what we're looking for is some short-term issues in the market or some short-term volatility. Sometimes volatility is good. Sometimes it's bad. In April, after the tariff announcement on Liberation Day, right, the markets were poor, right? That's a great opportunity to rebalance. So you might be selling off some assets that rallied to buy some assets that got cheap. A lot of the assets that actually got cheap, Craig, were on that AI thematic that you had talked about earlier. It was a great buying opportunity if you had the guts to step up or to rebalance at the margins. Likewise, we've had volatility to the upside in the Q3. Well, that's a good thing, but we have to, again, not get complacent and do some rebalancing. And so that dynamic rebalancing is just saying, hey, look, while you can rebalance once a year or twice a year at the close of the quarter, that might not be the ideal time to do it. And if you really do the math and think about it, you just want to time things a little bit better. That has nothing to do with timing the stock market, but there should always be a target of how you're allocated amongst all of these different asset classes. And we know if we're consistent and just make those adjustments at the margins every single year, that will put you, the investor, in good shape. The key, I think, in 2025 is it's hard not to have profits, right? Like lots of investments have gone up. And so as we rebalance in 2025, what we got to make sure is we've kind of got to set that capital gains budget and say, how much am I willing to recognize on my return? Because there are some thresholds that you might want to stay under for numerous reasons. Craig, we talk about IRMA all the time on the show, and we talk about this bonus deduction. What's IRMA? And then transition that into this special $6,000 tax deduction that a handful of retirees are going to qualify for.
Yeah, everybody knows the science and the leverage comes from bracketology. And I'm not talking about your NCAA bracket. It's October. It's not March. What I'm referring to is your marginal tax bracket, and then what ultimately leads to the formula of your effective rate. Effective rate meaning out of every dollar you earn, how much are you paying in federal and state income taxes? That being said, IRMA is one of those stealth taxes that's out there. That's income-related monthly Medicare adjustment amounts. And you know what? Some people pay a lot more for the same thing people get for less. And there's other people that pay tremendous amounts more for the same thing that is more expensive or significantly less than others. And it's your income that controls it. And David, last week we spent time on this program talking about doing Roth conversions because it's always appropriate to do them in the fourth quarter, but it has additional complexity this year because anyone who is 65 or older is potentially worth another $6,000. That's a $6,000 bonus deduction if you're 65 or older on your 1040. You're married, that's $12,000 in savings. But wouldn't it be a shame if you ended up with phantom income? That's a capital gain from a mutual fund. Wouldn't it be a shame if you did a Roth conversion that was a bit too much and you and your spouse lost that combined $12,000 deduction? That's why you need to be working with professionals that actually know and can do income taxes to make sure you have a better chance of not being led astray. David, what else would you weigh in on that very important topic?
This is about prioritizing. So, a lot of times we have competing interests. Do we want to get the special bonus deduction or do we want to do the conversion? And that's, a conversation that's going to be different for every family. This is why retirement planning has to be unique to your 1040, your tax return, and your investment resources. But if it sounds confusing, right, which oftentimes this stuff can be, take a deep breath. It's October. There is plenty of time to align yourself with a firm that can walk you through your 1040 and how option 1 might vary from option 2 and option 3. That's what we do well at VestGen, is linking your investments to your tax return to build that leverage. If we're worried about inflation, we can have conversations about how to modify investments. But we would be missing a huge chunk of it if we didn't say, how can we retain more of your income by saving some dollars on taxes? Now, imagine if we combine both of those forces together. That's real financial planning, and that's what people need to be thinking about. I feel great about this big, beautiful bill because my marginal tax rate is not going to change in the foreseeable future. But I'll put that asterisk mark on it, Craig. I know they say it's a permanent reduction. I just got this feeling, though, that like 5 years from now, we're all going to be facing much higher marginal tax rates.
Well, like all things, it's only permanent until Congress decides to legislate otherwise. But you heard it here. If you want to learn more about avoiding the net investment income tax, the ACA surtax, the income-related monthly Medicare adjustment amount, you want to make sure you get the full $40,000 of your SALT deduction because you're tired of being capped at 10 grand. You want to make sure you get your senior bonus deduction of $6,000. And of course, above all else, please, please, please do not get any phantom income tax on your return via some mutual funds held in the wrong type of account. We're here to help. 833-964-PLAN. That's 833-964-PLAN. Go out to our website, getretiredstayretired.com. That's getretiredstayretired.com. When you're on the website, poke around. Look at some of our media. Look at the videos. Get educated. Download some of those wonderful guides, like the One Big Beautiful Bill Act, a tax guide for investors. Last week, we had Gene, a thought leader in all forms of long-term care, continuity of care. Download from getretiredstayretired.com our short guide to long-term care. It's an excellent primer so you too can understand the differences between reimbursement, indemnity, traditional, hybrid, asset-backed solutions so that you too can protect from something that is so critical, which is spousal impoverishment. And of course, take advantage of a complimentary consultation by sitting down with myself, sitting down with David, one of our wealth advisors. If you're coming from this station, David and I, we share the passions that you do. We'll visit with you personally. 833-964-PLAN. More to come. Craig and David in the know, AM 560.
Okay, Windy City, get ready to be blown away with a hefty gust of financial know-how. You're listening to In the Know Radio with Craig Bolanos on AM 560. The Answer.
Well, hey, what are some of the things that you too need to know about a government shutdown? Because we're in. I watched the countdown clock. I saw what happened at midnight, and I feel like I've been here before. In fact, you know what? I've been here some 21 times before during my life, with the most recent government shutdowns happening in 2018 and 2019. Now, historically, government shutdowns have lasted a relatively short amount of time. On average, how long, you ask? Well, I can count it on two hands. That's just 8 days. But there was a time not that long ago that it spanned 34 days. That was 2018. Now, all of this is about appropriations. All about this is spending money. And what does it have to do with the stock market? Well, historically, but it's only historically, markets haven't been materially impacted by shutdowns. But I do remember other periods of time on the fringes where there were a lot of things that could have gone wrong but didn't. And there are an awful lot of things right now in this shutdown that could go wrong. Let's just hope that they don't. And I think that's why it's important, with markets at all-time highs, with valuations being where they are, that you too are rebalancing your portfolio in line with your risk budget, that you too are paying attention to one of the reasons the government shutdown is here. It's all about the money. And that's why we talked today, myself, Bob, David, in the studio on a Sunday, about the concept of real return investing. Because you need to be focusing, again, not just on nominal returns, but real returns. And as David stressed, real returns that are real after-tax returns. Because again, that's where all the leverage is. And as you look out to 2026, as you think about our theme of diversifying your diversifiers, there is a place for storages of value. We have talked an awful lot about digital currency. That is cryptocurrency. That is things like Bitcoin, etc. Other things that have finite amounts to them, precious metals, etc. And of course, if you want to be in AI, everybody, if you own stock indices, you already have big exposures to NVIDIA, Meta, Broadcom, Oral, you name the list. But there's other ways to play AI with less direct risk by participating in the ecosystem. You can loan money to those companies. You can have those companies rent real estate from you. There's so many different avenues that you can pursue. David is an expert at teeing those up. So connect with me, connect with David, connect with the team at VestGen Wealth Partners, 833-964-PLAN. That's 833-964-PLAN. Go out to our website, getretired.stay-retired.com. Listen, guys, this is America, and America is great, and we can do anything. Give us a chance to listen to your story and find ways to give you the improvement, not just the improvement that you deserve, but the improvement that you need.